Our next example is whether or not to take on a special order. So the rule of thumb with a special order is that if it doesn't affect your normal orders and you have the capacity to do it, as long as you're covering your costs, your relevant costs, you should accept the special order. What is usually not relevant as part of a special order decision are any fixed overhead costs. So only variable costs that are affected by taking on extra production are the relevant costs that we would think about as part of a special order. Other costs that we would think about as part of a special order are if there's costs that are required to customize the order in addition to any of our variable costs. So we have information here about a jewelry company that sells a gold bracelet. We have information about their normal unit product cost and their normal selling price. Then we have information about the special order. So we have a special order for 20 bracelets. They want a discounted price of $169.95. The members of the wedding party want customization that is going to increase direct materials by $2 per bracelet. We're also going to have to buy a special tool for $250 in order to do this customization. So we need to think about how those costs affect our bottom line with the customization before we take on the special order. One of the things that we need to think about as a special order is which component of our total overhead is fixed and which is variable. So this tells us that manufacturing overhead most is fixed and unaffected by variations in production. However, $4 of our total overhead amount is variable with respect for production. So that's something that we have to consider as part of our relevant cost decision. So we want to know what is the financial advantage or disadvantage of accepting the special order from the wedding party. So we have a per unit amount and the per order amounts. So our sales price or incremental revenue, this is also called incremental revenue, is the $169.95. That's the discounted price that the wedding wants. That is for 20 bracelets. So for the entire order, we have an incremental revenue of $3,399. Now we need to think about our incremental costs. So we have all of our variable costs. We have direct materials, direct labor, and the variable component of our overhead, which we read was $4. So we'll start with direct materials. Now remember that customization adds $2 to our direct materials. So we're going to have our direct materials of $84 plus the $2 extra from that customization. We also have direct labor. And our variable overhead of $4. So we have our per unit incremental costs of $135 times 20. For the order, we get $2,700. Now we also have this special piece of equipment that costs $250 for the entire order. So we need to add special equipment to our analysis. We now have total incremental costs of $2,950. So our incremental income is the difference between our sales price and the incremental cost, or $449. We would accept this special order because it's $449 that we didn't have before we took the order. It doesn't affect our normal capacity. We have the extra capacity, and it doesn't affect any of our normal customers' orders. Our next example is volume trade-off. Our next two examples are about constrained resources. When we have a constrained resource, we usually have a bottleneck. And so what a company wants to do is we want to maximize the profit per the constraint. So what is the profit per item of the constraint? So we have this company that makes hard-sided luggage for sports equipment. We have 3 different products. And what we want to know is, what is the capacity per constraint? I'm actually going to move that over one. What is our profit per constraint? So what is our contribution margin per constraint? First, our contribution margin. We know the calculation for contribution margin is selling price minus variable price. So we have our contribution margin for each one of the 3 products. Now what we want to know is our contribution margin per minute and the contribution margin per pound of plastic. So our contribution margin per minute is our total contribution margin divided by the number of minutes that item takes on the machine. And our contribution margin for plastic is total contribution margin divided by the number of pounds of plastic that we need. So now that we've done our calculations, we can look at our questions and do the analysis. So we have the contribution per margin of the constrained resource per product. And we want to know which product offers the most profitable use of the plastic injection molding machine. So if we assume that the molding machine is our constraint, we only have so many minutes available. We only have one molding machine, so we can only make so many items. Our demand for all 3 items is beyond what our molding machine can carry. So then we need to focus our production on the ones that give us the highest contribution margin per the constraint. So if the machine is our constraint, we would want to focus on ski guards because that's the most profit we make per constraint. We would make all of the ski guards that the market demand is for. If we have leftover time on our machine, then we would make all of the fishing guards that our machine can make. And only if we have time left over would we make any of the golf guards. The next question says, what if it's the plastic pellets that is the constraint? There's a severe shortage of plastic pellets, then which product should we create? If it's plastic pellets, then we should focus on the golf guard. And once we run out of plastic pellets, we would move on, or once we make all of the golf guard, if we still have plastic pellets left, then we can make the fishing guard. The next example looks at how do we increase capacity on a constrained resource. Well, it really depends on what the constrained resource is. If the constrained resource is the time on a machine, we can buy a second machine. If the constrained resource is direct labor, then we need to add extra laborers, overtime, a second shift. And if the other way that we can lift a constraint is to increase capacity by outsourcing part of the production. So in this example, we have a constrained resource of direct labor, and we're looking at two different ways that we can increase the capacity on our direct labor. One is in overtime and one is in outsourcing. So we have three products again, and we need to calculate the contribution margin per product and then our contribution margin per hour. So we take our selling price minus the variable cost. We have our contribution margin per product. And then we want a contribution margin per hour because it's per hour of direct labor is our constraint. So we take the contribution margin divided by the number of hours we need per unit. Number 1 says we're considering paying overtime to increase capacity on upholstery. All of that extra overtime would be used to produce sofas. So this middle item here. We want to know how much of an up to how much of an overtime rate per hour should the company be willing to pay overtime. Well, the most we would be willing to pay is up to the amount of the contribution margin. If we pay anything more than $60 per hour, then we're going to start losing money on sofas. So the absolute most we could pay in overtime is $60 an hour. The second question says, we can outsource to a small nearby company. They have offered to upholster furniture for us. They have high quality. They work just as quickly as our own craftsmen do. So we know that the quality is good. We know that we can get the same increased capacity out of them that we could out of our own workers. So we're looking at outsourcing Loveseats. And we want to know how much additional contribution margin per hour can we earn if we hire that upholstery company. Well, right now we have a contribution margin per hour of Loveseats of $100. If we have to pay a different company $45 in order to upholster them, that contribution margin is going to reduce to $55. Now, when we're trying to decide if we should hire the company or not, we might originally say no, because we're going to lose out on contribution margin. Our contribution margin per hour is going to drop from $100 to $55. But if we think about it in terms of capacity, what if we didn't have the extra capacity to make extra Loveseats? So the contribution margin of 0 is 0. If we don't have the labor hours to make Loveseats, we don't get the contribution margin. So in that case, $55 is a lot better than 0. So the outsourcing is a good idea in that situation.